What's going on, guys? Welcome back to the channel. Goldman Sachs, of all people, says that 4 cities are likely to see a 2008 style housing crash. The warning signs are out here, folks. We're starting to see some cracks, and this housing market is going to be really interesting. Now, we bought a house about 18 months ago. We got an interest rate of under 3%. Today, if you were to go out and get a mortgage, you're probably looking at, even if you have premium credit, 740, 800 credit score, doesn't matter, you're probably looking at about 6.3, 6.5% on a 30-year fixed rate mortgage. Well, Goldman Sachs is saying that 4 cities are likely to see a 2008 style housing crash. Now, this is still early, folks. This is very early. And if Goldman Sachs is seeing 4 cities likely to experience a 2008 housing market crash, how many more cities are there that are going to experience a crash? Maybe not quite as bad as 2008, but they're going to have pretty significant declines. That's the real question. Now, I'm not going to just come on here and talk about the fact that I think that the housing market's going to have a significant pullback. I'm not going to just do that. I'm going to take both sides of the argument here. I want to see, is there anyone who disagrees with this argument? Is anyone saying that there's going to be some upside? Is there some money to be made in real estate right now? Can you still make a profit? Now, me personally, I'm still investing in real estate. I'm investing in real estate through REITs, real estate investment trusts. I'm still investing in the stock market. I'm dollar cost averaging, and I'm looking for deals because there are still deals to be had in different markets. But in addition to that, I want you guys to know that I'm also taking a pretty strong cash position. And if you're in a situation where your job is at risk, if you're worried about your job, hurrying up to get out of debt, especially if you don't necessarily have the highest interest rates, may not be the smartest thing to do. Sometimes it's better to take a cash position, build your cash reserves, create a substantial emergency fund. That way, you can make your minimum payments, make your mortgage payment, make your rent payment, car payments, keep your cell phone on, keep your internet on. These are your tools, people. You need these tools to be able to continue to make money. So if you lose your job and you need to create an online business, or you need to apply for jobs, you need an internet connection, you need a cell phone to be able to receive calls, you need an internet connection to be able to find opportunities and to create opportunities, side hustles. We talk about that in a lot of our videos. So sometimes preservation is more important than just simply getting out of debt. Now, Goldman Sachs is saying that they're predicting the dark days in 2023. Goldman Sachs is predicting dark days in 2023 for some of the pandemic's red hot U.S. housing markets. Now, what's really interesting about what Goldman Sachs is saying, I want you guys to see this here. What's really interesting is the cities that Goldman Sachs is pointing out. It says here that the investment bank shied away from predicting a nationwide crash. So they're not saying a nationwide crash is coming, but they're not saying it's not coming either, right? But warn that residents in 4 cities in particular could see plummeting values that echo the 2008 housing market collapse, according to a note on clients obtained on New York Post. They said that the overheated market mentioned in the note were San Jose, California, Austin, Texas, Phoenix, Arizona, and San Diego, California. So first and foremost, if you think about it geographically, where are we? Okay, so we got San Jose, California, Austin, Texas. That is the West Coast. You got Phoenix, Arizona, West Coast. San Diego, California, that's West Coast. So you got 2 major cities in California expecting to see 2008 housing market crashes, right? But then you've got Phoenix, Arizona, and Austin, Texas. Now, if you think about it, what have we heard for the last countless months now? Layoffs. And some of the biggest sectors that we've seen layoffs in lately has been the tech sector. Microsoft laid off 10,000 employees. Amazon laid off 18,000 employees. Tech sector, right? We've heard from Google laying off I'm starting to forget, 10,000 employees? I forget. Somebody correct me in the comments down below. We're hearing from a lot of different tech companies laying off. Cryptocurrency related companies laying off workers. So this is what we're seeing. In fact, I mean, we even heard from Walmart laying off corporate staff. So in corporate staff, in any corporation, there's certainly a tech, there are technical teams. So within that corporate layoff, I'm pretty sure that there may have been some technical people laid off. My point behind sharing this information with you guys is I want you to think about what all is happening, and let's try to connect the dots a little bit. So where we're seeing some of these layoffs, at least in large quantities, is in the tech sector. Well, a lot of these tech companies are headquartered where? California. And so it doesn't really come as a huge surprise when I think about it. Not to say that this is why Goldman Sachs is predicting these particular 4 cities to experience a 2008 housing market crash, but it stands to reason that if a lot of these tech jobs are being lost and a lot of these companies are based in California, I'm not that surprised to see at least 2 of the 4 states, or at least 2 of the 4 cities in this list being in California. I mean, heck, Austin, Texas, that's a pretty big tech hub there. There's a lot of big tech companies in Austin, Texas too. Phoenix, Arizona, I'm pretty sure, but I'm not 100% sure on Phoenix. I just don't know the Phoenix area that well, but maybe you guys do. Comment down below. Goldman now believes that interest rates will remain high longer than expected, and notified clients that the bank is raising its forecast for the 30-year fixed rate mortgage rate to 6.5% for year end 2023. So they're revealing what they're expecting here. They go on to say that September 2022 marked the first time. September 2022 marked the first time since 2008 housing market crash that the average long-term mortgage rate surpassed 6%. So it's been a long time since a potential home buyer went to apply for a mortgage and found that the interest rate on mortgages would be greater than 6%. And we haven't seen 6% interest rates since 2008. So this is very significant. So you have 2 major catalysts here. You have interest rates at 15-year highs. You've got unemployment. You've got unemployment uncertainty. You've got job security uncertainty. There's a lot of uncertainty in the market. High mortgage rates combined with soaring home prices are currently driving some buyers away and contributing to a cooling housing market. Not surprised. Austin ranked the hottest real estate market in the United States in 2021 by Zillow and has fallen to 30th for 2023. Now, if you look at charts, right? If you look at, for those of you guys who do day trading or swing trading, you're investing in the stock market, you're looking at charts, candlesticks, bar charts, and you look at previous highs, you look at previous lows. Maybe you're doing some form of technical analysis if you're familiar with that strategy or that technique. Generally speaking, the stocks that run up the fastest in the shortest period of time, generally speaking, have this elastic principle to it, which means that they will generally pull back more aggressively than another stock that didn't necessarily run up as quickly. So if we apply that same thought process to real estate, the markets that saw the most explosive growth, unless there was some clear reason why this is going to be some long-term sustainable level of growth, generally speaking, you would likely expect to see some type of elastic pullback. And this is what we're seeing here. California, a lot of California markets saw explosive growth during the pandemic. And particular here, Austin was called out as being ranked the hottest real estate market in the United States in 2021, according to Zillow. So it's not a big surprise to me that Austin is pulling back and is listed as one of the 4 cities that Goldman Sachs is calling out to be potentially to experience a 2008 housing market crash. A lot of jobs at risk here. And I don't know if you've ever been in a situation where if you're at work and someone loses their job who you knew or is on your team, or just someone, a familiar face, even if it's not you that lost your job, all of a sudden your confidence in your job security is going to be feeling a little bit compromised, because you're like, oh, wow, that person just got let go. What if we're next? What if I'm next? And obviously this is going to affect buyer confidence. And if buyer confidence pulls back, that's going to reduce how many sales, how many properties end up getting sold in the interim. Now, taking the other side of this argument, Bloomberg is saying that housing demand climbs. Now, they're saying the exact opposite here. Bloomberg is saying housing demand climbs as U.S. starts to show signs of life. So Bloomberg, or at least the author of this particular article, who happens to be Prashanth Gopal, says that the housing demand is starting to show signs of recovery, with pending sales of U.S. homes rising for the first time in more than a year, according to new data from Redfin. So Redfin he's actually referencing data that came out of Redfin indicating that the housing market is starting to show some signs of recovery with pending home sales. Pending sales, according to him, pending home sales climbed 2.9% in December on a seasonally adjusted basis, the first month-over-month increase since October 2021, Redfin said in a report on Wednesday. Other measures of demand, including data on the brokerages, customers requesting home tours, and people contacting the company's agents, are up from November. He goes on to say, quote, the small uptick in pending home sales suggests some home buyers returned to the market at the tail end of 2022 after demand plummeted in the fall. After soaring borrowing costs battered the U.S. housing market for months, buyers are starting to see the pressure ease up slightly. The average rate on a 30-year fixed-rate mortgage dropped to 6.15%, the lowest level since September. Freddie Mac. So, okay, some buyers have come back. Are we done with this housing market crash? I don't know if I'm convinced. I don't see it. Number one, the Fed has not pivoted. The Fed has made it very clear, and they've been very consistent. Fed Chair Jerome Powell has been very consistent on saying that they're going to continue to raise interest rates. There is going to be pain. He promised even before that they started that there will be jobs lost. They had an unemployment target, which they have not hit yet. They're trying to raise unemployment, which means jobs have to be lost in order for them to hit their unemployment target. Housing prices are still very high. They haven't pulled back enough to offset the higher interest rates that are currently available at mortgage companies. So with that being said, to buy a home today, a mortgage per month is going to be so much more expensive compared to, say, a year ago or 18 months ago. In order for you to get a home today at the same price per month as you could have gotten it 18 months ago, home prices across the board will have to fall by about 30%. And we're not seeing anywhere near that. You used to be able to get a mortgage for 3%. Today, you're over 6%, 6.5%, 7% if you don't necessarily have prime credit. And that's just the fact of the matter, guys. And just because you see a little bit of uptick here and there, it doesn't mean that this is actually recovery. I mean, this could be a little bit of a dead cat bounce, if you guys are familiar with that term in the stock market world. What that means is that when a stock is falling, it's falling, and then you see a little bit of an uptick. A lot of people feel like the stock market crash is over because they see this little bit of an uptick. But then a reversal takes place and it heads further down. So this could be a fake out where it's like a dead cat bounce and there's more decline to be seen in this particular asset class. Now, here's another thing that's not really discussed, or at least I didn't see that in this article yet because I didn't read the whole article. I'm just kind of sharing this with you and going over it with you as I'm reading it. You got to take into consideration the fact that we have seen an unusual number. This is a historically high number of contracts and deals falling through. Talk to any agent nowadays, talk to any mortgage lender, more and more deals are falling through. And just because a an offer is accepted. Just because a home that is for sale goes under contract doesn't mean that it actually makes it to closing. Several factors are coming into play. Some of which is the buyer. The buyer sometimes has buyer's remorse, and they're like, oh my God, what am I getting myself into? Bob just got laid off, who I used to talk to over at the water cooler every single day. If he got let go, now I'm not so confident in my own longevity here at this company. Maybe I need to back out of this deal. Let me just stay put. Let me wait till this dust settles. I'm just saying, this is just human psychology. These are things that people are thinking. Another thing is with banks seeing what's happening with interest rates and layoffs going on a fairly global, well, not really global, but on a growing scale, we'll say that. Banks don't want to take on the same level of risk that they used to. So the banks can, and we're seeing this already, banks are increasing their criteria for being able to be approved for mortgages. And, you know, some banks are saying, hey, we're not going to lend 100% on this home. We're not going to lend 95% on this home. We want you to put 10% down, you know, 15, 20% down. Depends on your circumstances, depends on the bank, depends on if you're borrowing from a credit union, a mortgage broker. There's a lot of different factors. But if we continue to see more and more deals falling through, fewer and fewer transactions going through, and then their sellers sitting on the market, bringing their properties to the market, they're going to get to a point where they're like, hey, I got to lower this price because we're not getting enough activity. How far down are we going to go before crap really hits the fan? Anyway, I just wanted to share some information with you guys. Let me know what you guys are thinking. Are you in the housing market to purchase? Are you in the housing market to sell possibly? Are you in the housing market to invest? Let me know what your goals are. Let me know what you guys think about what I shared with you guys today. If you haven't already, consider subscribing to the channel. Also drop a like for the video. I appreciate it. I will see you guys on the next one.